Hey there, awesome accounting student. Mark Franke here. Today, this is a video for Accounting 101, Chapter 7 on Accounts Receivable and other kinds of receivables as well. So this chapter is all about companies, customers that owe us money, and how we are going to account for when people don't pay us, because we have made a decision to extend credit to our customers and sometimes they don't pay. Either they've gone bankrupt or they just, for whatever reason, are deadbeats. So that happens. And in fact, the reason we extend credit is to stimulate sales. And so as long as the additional sales that we stimulated is more than the bad debts or the stuff that we have to write off, then it's a good business decision. And for most companies, it works just fine. Here we're talking about selling to a customer and extending terms, and then trying to figure out who is going to pay us and who is not, because we want to make sure that at the end of the period, the end of the month, the end of the quarter, the end of the year, we have our receivables on the balance sheet, which is an asset, at its net realizable value. Net realizable value means how much are we actually going to collect. So we have to provide an adjustment for what we think will not be collected. And so to illustrate, I'm going to use problem 7-2b, and then we'll do 7-3b. 7-2b is on page 297 of your textbook. And what they have given us is some information, and they want us to do this 3 different ways. So the first way is to base it on a percentage of sales. Percentage of sales, in this case for the one, is 2.5%. So what we're going to do, and we'll label this A, and I didn't give you a work paper. This is just a general journal. If you want to pause the video and set up a journal so you can follow along, that's fine. Probably should have some journal paper handy anytime anyway. But anyway, so set up a journal. And this first transaction, and every single one of these, we're going to have the same debit and credit. The debit is going to go to a bad debt expense, and the credit is going to go to allowance for doubtful accounts. This is a new type of an account. Allowance for doubtful accounts is a contra asset account. This is going to be married together with accounts receivable, and it's going to hold a reserve or an allowance for customers we don't think are ultimately going to pay us. So this is to record estimated bad debts or something like that. We don't know the amount yet, but we will. But we have to prepare a schedule. So this is going to be based on credit sales. And credit sales is 1,342,000. And they estimate their bad debt percentage based on credit sales is 2.5%. So our estimated bad debt amount, we're just going to multiply it out. We get 33,500. We're going to debit bad debt expense and credit allowance for doubtful accounts. That's based on credit sales. we can do the same thing, but in this case, it's based on total sales. This will be transaction B. We're going to have the same exact debit and credit, so I'm just going to copy and paste those down below. But in this case, and this is still to record estimated bad debts or something like that. But this time we're going to take both cash sales and credit sales. Of course, it doesn't really make sense to do this on cash sales, but that's what they've told us to do. But total sales includes both the cash sales and the credit sales. Cash sales is $1,000,025. Credit sales is 1,342. So total sales is 2,367,000. Our estimated bad debt percentage based on total sales is 1.5%. So our estimated bad debt amount is the 2,367,000 times 1.5%. That's 35,505. 35,505. So both of these approaches for A and B is based on sales or the income statement. And we just used a different percentage, one based on credit sales, the other based on cash sales. The third method is going to be based on a percentage of accounts receivable. So this one, we'll call this one C. Once again, same exact accounts involved, bad debt expense, and this time I'm going to get all three of these guys. This is scenario C. But this time it's going to be based on accounts receivable. Accounts receivable at the end of the period, and this is a balance sheet approach. Is 575,000, and our estimated bad debt percent based on receivables is 6%. So our estimated amount of bad debt in accounts receivable, if we multiply that out, is 34,500. However, that's not going to be our adjustment because we have to look at the balance. Again, this is a balance sheet approach. The balance in the allowance for doubtful accounts and our balance in allowance for doubtful accounts is a credit balance of 7,500, which means that our adjustment amount is what it's going to take to bring it up to the 34,500. So we will debit bad debt expense 27,000 and credit the allowance for 27,000. This is the balance sheet approach. So we're making the allowance for doubtful accounts equal the balance that we anticipated that it should be. And then they've asked us to calculate the net realizable value. And so the net realizable value is the difference between the balance in accounts receivable, which is 575,000, and the balance in the allowance for doubtful accounts, which is now going to be 34,500 credit balance. So the net realizable value, in other words, what we think we will actually collect from these customers, is 540,500. And that's how this will be presented on the balance sheet, something that looks like this. So this has been for scenario A. This is requirement number 2 and 3, where they've asked us to calculate the net realizable value for these two different scenarios. Part 2 is for the A scenario, part 3 is for the C scenario, and this is what it would be. So another balance sheet approach to this would be similar to what we're going to do in problem 7.3b. 7.3b, I've prepared a schedule that looks like this. Again, if you want to pause the video and prepare it, I'm going to change it to be 2019. And we're doing something very similar to what we just did in item C, but here, rather than take a flat percent on all of accounts receivable, we're going to categorize our receivables based on age. This is very common because, as you can imagine, if a receivable hasn't been paid for a period of time, whether it's 2 months or 3 months or 4 months, the older it gets, the less likely we're going to collect it, right? Because if the company was going to pay us, they would have paid us by now. And so we're going to now categorize our accounts receivable into aging categories. Again, this is very common in the real accounting world that we do this based on an aging. So if we have in our first category, not yet due, that's 396,400. Our 1 to 30 days past due, in other words, if our terms are net 30, and most companies have terms of net 30, now these in this category, 1 to 30 days past due, is in the 31 to 60 days from the date of the invoice. That's 277,800. A higher percentage of that is going to be not collected. In this case, they've suggested 4%. And these are based on some sort of a historical trend. Then 31 to 60 days past due is 48,000. 61 to 90 days past due is 6,600. And over 90 days past due is 2,800. When I total these up, I get total receivables of 731,600. So these numbers are in your textbook. And we're going to use 8.5% for 31 to 60 days past due, 39%, and you can see it jumps way up at 61 to 90, and then over 90, 82%. You know, I don't know why that wouldn't be 100%, because if something is now over 90 days past due, those people have left town, they're not going to pay. So what you might do here is stop the video, do the calculations, and then total it up and see what you estimate as the bad debt. And I will do it and be right back. Okay, so if you did the math, you should have gotten 27,990. If you didn't get 27,990, check your math. but that's just literally multiplying the balance times the percent to get the estimated bad debt. And it said that the allowance for doubtful accounts had a $3,400 debit balance. In other words, this account, this contra asset account, had a debit balance of $3,400. It's supposed to have a credit balance, and we want the credit balance to be $27,990. We want that balance to be $27,990, which is what we calculated down here. So this is, in order to get that balance to be what it is, we have to add together the $27,990 plus the $3,400, and that's going to be $31,390. And that's going to take our balance and allowance for doubtful accounts from that $3,400 debit balance to the $27,990 credit balance. So our adjusting journal entry is going to be $31,390 debit bad debt expense, and $31,390 is a credit to the allowance for doubtful accounts. This is, again, a balance sheet approach where we're taking the balances in accounts receivable, putting them in aging categories, coming up with a percentage based on history of what happens, and then adjusting so that the allowance for doubtful accounts matches the balance that we've calculated. Okay, that's it for this video. Thanks for listening, and I'll see you again next time. Bye-bye.